If the market cannot hold what I'm calling the do or die zone, then the worst is yet to come. The zone is between the weekly 50 SMA, the daily 200 SMA, and a high volume node that aligns with a previous breakout level. And even if the zone does hold, I'm not convinced that it's smooth sailing back to the all-time highs. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points, including a few new currency charts, and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we've got ourselves a solid red-bodied bar with just a little bit of a lower wick, which of course would imply that buyers stepped up towards the lows of the weekly range. However, I would still argue that the sellers accomplished a fairly heavy close down here in the lower third of the weekly range, so structure is absolutely bearish. If we're thinking about location on the bar-to-bar count, notice that we have a clear lower high, as well as a lower low, but the most important part is the close completely outside of and underneath the previous week's range, so location is also bearish. And keep in mind that on Wednesday we had acknowledged, and we also just talked about this last week, we had opened in the upper 50% of the previous week's range. The previous week's bar had a stronger lower wick, implying that buyers were trying to step up to try to produce some sort of equal low down here. Clearly, that was not the case, and we saw downside follow-through. A stronger market would have not even tested the previous week's range low, never mind tested the double top neckline, which we'll talk about right now. Of course, the major trend is that we have lows, higher lows, we had higher lows, and we had higher lows. Key point being had, past tense, because now we have highs. We have, for the most part, equal highs. If you want to split hairs with me, yes, it is technically speaking a higher high. But this low has been violated. We've broken down through that. So the neckline of the double top here has been broken. Now, I want to make note that, of course, the close complicates things. We did not close definitively underneath the neckline. You can see that the weekly 50 SMA is starting to try to act as support. And as mentioned in the intro, if the do or die zone cannot hold, that's where I think more trouble steps in on the higher time frames. The do or die zone is this level right here, combined with the daily 200 SMA that we'll see in just a moment. Recall that on the weekly we had previous resistance. Previous resistance acted as support once we had broken out through it, and then we produced a higher low above the level here. Now, although we did not close the weekly bar underneath the neckline, after making a lower low, I would argue that the next threat from the weekly perspective is that any lower highs that then come back down to the equal low, testing the bottom end of the do or die zone, that is a weekly trend reversal. And we're really going to see this with a lot of clarity on the daily time frame chart, because we know that this box here represents overhead supply, and this lower high is the nasty threat. So even if there's a counter trend move this week, if we are underneath roughly 590.25, we'll see this with more detail in just a moment, be thinking about a weekly lower high to change the weekly trend here. Obviously, straight up continuation to the downside speaks for itself, and the next major level that we can think about here is the monthly higher low pullback thesis, which is down to about 525. As a reference point, this here is closer to about 565. Let's go ahead and quickly check in on our Fibonacci's from the bottom of this move up to the all-time high. Notice that we pierced the 38.2, but we did not close underneath the 38.2. We had also made note that this is almost perfect confluence with the double top neckline. If we bring out the anchored view apps on the weekly time frame chart, we can see a couple of new ones have been added here. I've added back in this pivot low as well as this pivot low, and this is confluence with the low of last week. It's also the weekly 50 SMA. It's right there, basically at the same level, reinforcing the idea that if we were to take this out, there's some room to fall to the downside, and lo and behold, if I do something that looks like this, your monthly higher low thesis may just align with the anchored view app from the October low of 2023. Now, I want to be very clear. We can see the possibility of downside. We can see how this path will unfold into the future if a lower high is set and we breach the equal low. We can understand that. Is it worth jumping the gun and being aggressively bearish after last week's close has come back up and over the neckline of the double top? I don't think it is. And the reason for that is we know that in the grand scheme of things, markets tend to trend in the upward direction. And usually, the saying goes, is that bears sound smart, but bulls make money. And I think we want to keep that at the top and forefront of our minds as we move forward from here. If the weekly is going to fall into just a balance range, if we do not take out the lower edge of the do or die zone, last week's low, then I think that we can maybe watch out for that lower high, but then we also want to keep an open mind to a possible daily higher low that would shift the smaller time frame charts, okay? And this is, again, the zone that we're using, the do or die zone, is important. It's not just like, okay, we're under the daily 200 SMA, the market's got to fall apart and go to zero, right? We're trying to give the benefit of the doubt, but we can only move the goalpost so much. This technical area of support makes a whole lot of sense based on everything we've walked through so far. The change in trend makes sense if we spot a lower high and if we come back down to the equal low. But really, breaching through this level is where there's a lot of danger to the downside, and that's what I was talking about in the intro, where if we break the do or die zone, the worst is yet to come. Something I'll remind you of is that markets crash from the lows, not the highs. And I would argue right now, we're at the low end of a balance range here. And again, crash can be defined by a number of things. Bear market territory typically down 20% plus, right? Corrections 10% plus. What do we have so far? Let's quickly come in here with the measuring stick, and then we'll move this thing along to the volume profile. I'll show you the high volume node, and we'll get down to the daily. We're about a 7.91% move from the all-time high to the lowest low of last week. That's not even correction territory yet here on the weekly time frame. And what we want to compare this to is actually this drawdown from over here, because we know that this also aligns loosely with the fundamental revisions to the downside out of the S&P earnings estimates, and we'll get to that in the fundamental section of today's episode. But this was a correction of about roughly 10%. And we know that on any given year, it's not uncommon for the S&P to pull back about that magic 10% number. There's a handful of 5-ish% pullbacks, and then there's usually about 1 or 2 10% corrections. So could this be that? I think the answer is yes. And therefore, we're giving that do or die zone the benefit of the doubt on the higher time frame charts, specifically because of the way that last week's bar closed. It closed back above what we're calling the double top neckline. And of course, the double top, I don't think I drew it in, but there you go. That's the double top we're referring to. So with that, let's clean this up. Let's throw on the volume profile. Let me show you how the high volume node also aligns with this breakout level. If I do something that looks like this, I know it looks like, it's because of the way that the rectangle has actually been drawn. It looks like a low volume void, but it's the high volume node just before that low volume void, right? And if we can support off of that, basically last week's low, then perhaps we can remain somewhat more neutral and trying to be somewhat more optimistic about the market making a recovery. If we fall below that, now there's just too much technical breakdown where I would argue, yeah, we've got to go with the flow here. Absolutely, on the higher time frames, we have much larger concerns that have emerged in the market. So with the higher time frame conversation complete, let's take a look at the daily time frame chart here and firstly evaluate this week's expected move. It's quite large. It's off the screen. Let's get it on the screen. Here we go. It's this box right about here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner, and here we go. The upper edge is at 591.05, implying a big-time lower high, of course, underneath the all-time high, but I would also argue that the forecast lower high is underneath the previous cluster of highs that we saw up against the daily 50 SMA for a rejection in not last week, but the week prior to that. Of course, the lower edge of the weekly expected move is down here at 560.67, implying a breakdown of that key zone, the do or die level that we had talked about, roughly 565. If you want to get nuanced here, it's 564.65. We'll talk about that in more detail in just a moment. So expected move is bearish. The daily trend is bearish. We now have highs. We have lower highs, we had lows, this made a lower low, and this, of course, undoubtedly, the low of last Friday is a lower low. Now, in the intro, we called the do or die level, technically zone, we called it a zone for a reason. It's because these clusters of lows here, primarily from the Tuesday, Wednesday, and Thursday session, align with our daily 200 SMA, the green moving average on your screen. And that zone, if you want to call this a zone here, it's a zone at the top of the do or die zone. If I had to label these things, let's just do it, right? This is the DoD, not the Department of Defense, but rather the do or die zone. And this is sort of a small clustered zone at the top end of the range, the previous structural lows and the daily 200 SMA in green. The 573 level will be absolutely critical because we did technically close above it on the Friday session. And as we'll see on the hourly time frame chart, there's the possibility that we have a little bit of a look below and fail here, in which case a counter trend move is not unreasonable. However, we were very careful with our words the past couple of weeks even, saying that this is a counter trend move. Any upside action that takes place here is counter to the definitive downtrend that the daily has fallen into, the definitive downtrend that the weekly has the potential to make. Now, where is the opportunity for the last lower high before I would say, okay, maybe there's a stronger recovery than originally anticipated? It's this level here. It's the upper edge of the weekly expected move. As you saw in the weekly time frame chart, I said something like, there's plenty of opportunity for something that looks like this. That lower high is right here up against these previous lows, and we also had intraday inflection points back here, 590.25 weekly upper edge of the expected move. If a lower high is set there, it's not just a daily lower high, it's a weekly lower high. And that threat is meaningful because, as we know, stronger moves in the market, only to the downside that is, really only unfold when the weekly is literally weak, when the monthly starts to suggest that there's the opportunity for a downtrend there, and it all stems from a change on the daily. So 590.25 lower highs, incredibly important to watch out for this upcoming week. That would keep all of the traders trapped up in this box here as OHS. This is our new favorite acronym around the channel now that the market has broken down a little bit more definitively. Overhead supply. All of these trapped traders, if they want to get out for break even, if they haven't sold already, they're likely to sell here, right? So that 590.25 is absolutely paramount. What else can we say here on the daily time frame chart? Of course, the structure from the Friday session might suggest, right? We talked about the lower wick and then the close back over that 573. It might suggest that the counter trend could happen sooner rather than later. So we'll keep that top of mind. But if we take out the Fibonacci's for additional confluence, clearly from all-time high to the low, notice the 38.2 is near a key level around 584.75. We'll see that as the two-day high from Tuesday and Wednesday. And the 61.8 is also pretty much defining this as overhead supply as well. Daily 50 SMA is there for confluence also. I'd still primarily use the 590.25. I think that makes more sense from the weekly perspective, but the fibs are aligning with key structure nonetheless. Let's take this off. Let's drop it down to, before we go to the hourly, let's actually talk about bear flag consolidation. If we start to break the do or die zone lows here, 564.65, first stop, lower edge of the weekly expected move, and also a key technical level at 559.50. Beyond that, we're talking about 548.75. Now, clearly, it looks well extended beyond the lower edge of the weekly expected move, but what do we know about this market? Look at last week. Look at the extension through the lower edge of the weekly expected move. Is this really unreasonable? I would think absolutely not. Another conversation point to have here on the daily time frame before we get to the hourly is just that we haven't seen capitulation yet. And this will tie into the sector analysis in just a moment. It'll tie into the volatility analysis in just a moment as well. But for the most part, do you see anything on the daily time frame chart that's like, oh my God, that's capitulation? The answer is no. We honestly have not even seen a gap down in this market, right? There's been, maybe this was the closest we got on Tuesday of last week to a gap down in this sequence. There's been no gut-wrenching gap down. Oh my God, I can't believe the market's gapping down 15 points, and oh my, what are we going to do? Panic this, panic. We have not seen that capitulation yet. We have not seen blood in the streets across all of the S&P sectors at the same time. There's still some semblance of rotation. So is this a capitulation style bottom? Is this going to mark the end of the move to the downside? Based on volatility and how we know bottoms typically form, the answer is no. Bottoms typically happen very quickly. Tops usually take some time to form. Now, if we take a look at this, what's one term for this? This is almost a perfect textbook Wyckoff distribution. If we see continued acceptance, in this case, it would be underneath 584.75. Continued acceptance here, That spells trouble from a classic distribution standpoint as we consider the overhead supply. So a number of bearish interpretations here on the daily time frame chart. I think it makes the most sense considering everything we're about to cover with the supporting evidence. Where do I change my tone? Where do I say, okay, let's put that on the back burner. The weekly did not break down through the do or die zone. Let's start to look back to the upside. Where does that take place? Well, for me, it would have to be a rally that at least makes it to the 590.25 and then pulls into an obvious higher low inside of the weekly range. And for that, you might just be using 584.75. If we get something that looks like this and we start to accept in this zone, maybe we change our tone and we're less aggressive on the bear side. But for now, I would think that this is met with a breakdown back to the equal lows, a test of the daily 200 SMA is bye-bye, weekly 50 SMA, and the rest is history from there. My primary thesis, my base case analysis, given all of the data points and metrics we're going to explore today, is that it's very possible this is what we should be thinking about. Right here, lower high up against that 590.25. Enough conversation on the daily. Let's drop it down to the hourly. Let's take a look. Something to point out here is that there's been plenty of two-sided trade. In an outright, quote, crashing market, oh my goodness, we're going to zero, this is capitulation, you're not going to get two-sided trade like this. Are you kidding me? It's going to be straight down. There's no escaping. There's no panic. Everybody is saying sell, 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 sell. It's the opposite of Kramer and his buy button, right? So this two-sided trade automatically indicates to me the market's not capitulating here. And we can see this in the sectors. We can see this in volatility. The range is massive. Don't get me wrong. There's such an expansion of range in here, and any given 5-minute candle these days is huge. But for the most part, it's two-sided trade still. Buyers and sellers are almost equally interacting, at least in this part of the range that we're exploring. So as we think about what's possible early on in the week, well, I would certainly look at this through the lens of we have a balance range here, and I can even zoom in on this a little further. There we go. If this is a balance range here, because primarily we had Tuesday, Wednesday inside bar, Thursday looked below and started to fail early in the Friday session. Of course, we had some volatile headlines come out, but where did we close? Where did we close relative to the origination of the 2-day range, primarily Tuesday and Wednesday? We closed over, right? We closed over the bottom end at 573. So you could start to make the argument that perhaps this turns into an inverted head and shoulders. And I would primarily be interested in whether or not the market can hold early on in the week 573. If it can, then great. Maybe there's some sort of long entry here to retest the top end of the range. In which case, our first thought when and if we get to 584.75 would be, okay, let's look for a lower high. If we go through 584.75, where's the next lower high? It's the daily level we were just talking about, 590.25. So that's my first thought on the SPY hourly chart, is that we've seen a look below and fail. Technically, the market's trying to find buyers near the daily 200 SMA. I think that that's sort of it's a very elementary way of looking at the market. I think that the 200 it's just a moving average, right? It doesn't have any special power to it. So there's that. But 573, if we could stay above that, I do think that the counter trend can step in here. Now, of course, if we're underneath 573, where are we? We're in the do or die zone. This is the do or die zone as we know. And that would totally just be bearish consolidation. So a trade that you might look for could be any early week rejection of 573. So a move back underneath the level, looking for a lower high here, trade to the equal low. That's your weekly 50 SMA, the bottom end of the do or die zone. Any consolidation persists as being bearish. And then, of course, the Brigade Bolt cracks this thing open to the downside. It's goodbye underneath 564.65. So that's the bull and bear take here. I think that the counter trend is possible based on the way that Friday closed. Another consideration is just that with the volatile headlines we've seen, and of course a weekend that traders would potentially have to hold through, it's very possible that shorts dead on the lows of the move are potentially unloading those shorts, causing a little bit of a short squeeze, right? Just over the weekend. It does not seem to me that these are new money buyers stepping up here for the second half of the Friday session. It just seems to be a little bit of a short squeeze. Let's unload these shorts ahead of the weekend. So 573, if you're looking for the nuanced trade early on in the week, that's the key level. This doesn't change the fact that on any moves, these are still counter trend rallies in the face of a daily downtrend and a potential weekly downtrend shift, so long as a lower high is set underneath 590.25. As mentioned, I would start to change my tone if the market finds acceptance after finding a move to 590.25, something that looks like this, and then goes on to test something like 595.85 on the daily. It's a little cleaner, right? We can go back and look here. And I know I already went over this, but we'll do it one more time. Something that looks like this, and then acceptance over 590.25. that starts to become a little bit more compelling for, oops, we want a rectangle, please. A little bit more compelling for a bottom being formed. Now, you can sit here all day and say, like, dummy, you missed the bottom. If the market's going to go back into an uptrend, and we talked about this last Saturday, if the market's going to go back into an uptrend and everything's going to be fine and dandy and, oh my God, we have nothing to worry about, the move is not to here. The move is to, like, 650, right? So from a long-term perspective, that no problem. Show me the confirmation before I get overly leveraged on a longer-term account. I'm fine missing this much of the move, seeking confirmation if I'm a believer that the trend has firmly flipped back to up and we're going to go on to produce new higher highs from the weekly perspective. I mean, come on. A little confirmation is worth the added waiting period, if you will, for the move to the proper technical level, right? So that's what we have there. That's the daily, that's the hourly. Excuse me. Let's see what else we can see from the intraday. Let's quickly take a look at the anchored VWAPs from this point of view. One of the things that I find quite compelling would just be that the low of the move anchored VWAP is starting to coincide with that 573, and he opens over 573, that support there. I think make the argument for the counter trend quite valid. Just noting the look below and fail pattern we've already talked about, it would be something like risk and reward to the upside, right? So that's that. Any breakdowns below, we talked about bearish consolidation, equal low breakdowns, unlock the weekly move to the downside underneath the do or die zone. Been very clear about the expectations here. So that's that. Let's move along to the market internals for the S&P side of things. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see on Friday's counter trend move into the afternoon? Why am I saying that it doesn't look like new money buyers are stepping up into the market, right? Well, we saw some volume flows to the upside, but it did not breach positive 300 million. The net flows on the week were still negative. If you take a look at the breadth ratio, let me see if I can remove this study. There we go. Breadth ratio on the Friday session really didn't breach up and over 2. If you're going to have a strong, new money buyers stepping into the market, driving the market to the upside, well, the first thing is that you're going to see the market trend all day in the upward direction. It's going to be one of those days that's very, very annoying to participate in because it feels like, oh, I'm buying the top of the move every single moment of the day. But you're also going to have volume flows breadth-wise that is greater than 2. That's why we have this delineated here on the upside. Just like when stronger sellers are participating, usually we look for underneath negative 3, which we've seen a number of times this past week. So new money buyers are not here from a volume flows perspective. They're not here from an advanced decline line perspective. This should be in trend higher zone all day. When new money buyers are getting involved, it's like a gap up over a previous down day to mark a capitulation bottom. We've not seen that yet. The index score intraday has been wishy-washy almost all week, which makes sense, right? We were talking about two-sided trade in here. That's pretty characteristic of that. And the cumulative build out of the tick really bearish on that Thursday session, breaching underneath the 2-day lows, right? But on the Friday session, as we rally, could we even make it back to the zero line, never mind positive? The answer is no. So do we have new money buyers stepping up even though there's a counter trend move? The answer is still no, and it still looks like a short squeeze as we head into the weekend where shorts don't want to hold. They don't want to hold on to that headline risk. Let's take a look at the market profile. If you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. For the most part, we want to acknowledge the balance range from the Tuesday and Wednesday session here, and that the look below and fail starts to look pretty valid with the value overlapping to up, but notably the point of control back inside of the balance range. Stronger sellers probably would have kept the point of control down here towards the lows and not allowed it to value, when I say it, not allowed value to shift back into the range. So any holds over, in this case in the ES futures, something like 57.45, any holds above that really start to suggest more of that rotation back to the top end of the balance range. The two equal highs become the target, much closer to 58.80. So we'll refine these levels, of course, in the pre-market prep when we're more dialed into the futures analysis. But so far, that's the look there. I would point out and recommend that you carry forward the poor high from the Thursday session, and the poor low from the Friday session. The auction is incomplete at the bottom end of the move. Again, it does not look like capitulation down here. As we zoom in a little bit further, it just looks like lack of material excess. There is technically a single print in the E period there, but not by much. So lack of material excess is still the improper end of the auction. We should carry that forward in the narrative, just noting that when and if we were to retest the low of Friday, we should expect that to break down, right? And that would also trigger, as we know, the breakdown of the do or die zone. So that's your ES, that's your S&P side of the market. Let's jump on over to our good friend, the QQQ NASDAQ 100. Let's see what's going on from this perspective here. Jumping it up to a weekly time frame chart, clean drawing set. What do we have? Do we have a do or die zone? Well, let's keep it structured. Let's remain civil here. That's what do we see out of candle structure and location. We've got a very similar candle to the S&P 500, of course, solid red-bodied bar, a little bit of that lower wick buyer stepping up towards the lows, but still a pretty heavy close down here. Bar-to-bar count is bearish with the lower high as well as the lower low and the close underneath the previous week's range low. As we're thinking about the double top, this is a little bit more extreme, noting that we did close underneath the double top neckline and we did puncture the weekly 50 SMA. We also know that the neckline was so important here because it aligned with the previous high from back in June, roughly, of 2024. So the fact that this market is broken down more so on the NASDAQ side means to me there's just even more opportunity for the lower high. The lower high could be here on the retest of 500, or it could be slightly higher towards these 2-week lows around 512, 510, which we'll see in more detail on the daily chart in just a moment. Regardless, doesn't matter how you slice the cake here, that is absolutely a bearish opportunity. Now, we can look back through history and we can say things, and we probably could do the same for the S&P 500. We could say things like, the weekly 50 SMA typically acts as support. What do we know about the August 5th gap down over here? That was a capitulation style, like someone stabs you in the gut, twists the knife. Oh, it can't get any worse than this, can it? This is panic. This is outright fear. That's capitulation. This is a weekly gap down. Recall that, right? We have not seen capitulation into the weekly 50 SMA. We've seen, in my view, quite an orderly sell-off. It's been very clean to the downside, straight into a reference point. We've broken down through a key level. Is this a 50 SMA touch on the weekly that we want to be buyers of? Not really. I mean, there's two ways to frame it, right? You probably don't want to be a brand new money short into the dead lows of the move. And we actually called this out on X over on Friday. We called it out to the Discord first, but on X, we'd said it probably doesn't make sense here to be a brand new money short dead on the lows of the Friday session. So new money short here doesn't make sense, but is it a buying opportunity? With the overhead supply and the way that the market has pulled back, to me the answer is no still on the weekly chart. It would need to see some improvement here and not so much of a threat for a weekly downtrend. Notice that we did close underneath the 38.2, which is just confluence with this neckline, so not a big shocker over there. If we bring out the anchored VWAPs on the QQQ, we've broken a majority of the cluster now and even closed underneath some of these key reference points. Of course, this anchored VWAP is still in play as a potential area of support. Weekly 50 SMA is loosely aligned with that. And then this one down here is a potential downside target should the market come in even more aggressively. On the QQQ, we're talking about something like a 452, 450-ish target based on previous structure, resistance here, acting as support after the yen carry trade lowest low, and then that would also coincide with, of course, our anchored VWAP as explored. Let's check in on the volume profile and make sure we're not missing anything from this perspective here. The answer is, survey says, high volume node. So we do have the neckline of this double bottom to potentially act as support. In my view, it's there. It's something that we can watch out for, but as noted already, I think the risk on the NASDAQ weekly is much more about the lower high underneath the overhead supply, or even if we do go a little bit further, something like that 510, 512. So let's see it with a little bit more detail on the daily time frame chart. Here we go. Let's begin with our weekly expected move, and then we'll jump into the trend, so on and so forth. What do we have out of this analysis? There we go. Expected move is here. The upper bound is at 508 roughly, and that, of course, would imply a lower high in the trend count, no matter how you slice the cake, from here or from here, the all-time high. And if we're contained by the lower bound, it's a lower low. The number is at 475.58. Not quite, it's really not much further, I should say, than the previous week's low. It's definitely a lower low, but it's not a huge extension. As noted on the S&P 500, wouldn't be a shocker to break through the lower edge of the weekly expected move, as we've seen in both of the indexes so far. As we're thinking about the trend here, sitting on the lowest low, hammer candle on the Friday session, closing back inside of the Thursday range, underneath the daily 200 SMA. So this is a little bit of a weaker looking chart relative to the S&P 500. To me, the counter trend still seems available here, but as noted, you could get a lower high off of 500. You could get a lower high here. My line in the sand is really that 510, right? And we can see why it's so clear as overhead supply up here. So any lower highs on the daily time frame chart will also be lower highs on the weekly time frame chart, and 510 is that line in the sand. It does appear as though a counter trend can take place. You sort of have a look below and fail on Friday, below Thursday's lows to close inside of Thursday's range, and the level, unlike the S&P 500, instead of pulling back to a level first, it would be if we can open on a gap up, or if we can rally up and through 492.50, hold that level, it would then be above the daily 200 SMA. That's where we may get the rotation to the top end of the range here at 504. When I say range, I'm referring to the Tuesday, Wednesday inside bar combination here. Thursday was mostly inside as well. It did flirt with the lows of the Tuesday session. To the downside, if this rejects, let's just say that this is just bearish consolidation. We go sideways. We're underneath 492.50. The market can't break out or gap up and over it early on in the week. The next downside level is something like 477.25, and then beyond that would be 470.50. Let's zoom out on the daily so we can see these reference points, right? I want to make it very clear that the 470.50 level is a dangerous one because this is very thin structure, right? You can see here that we had this bull flag consolidation, which was successful. We broke out and held a higher low above. But if we're underneath that, it's straight back down through the flagpole to the top of this consolidation at 460. So that's what we're thinking about to the downside. And as mentioned on the weekly chart, that would start to align with, if I grab another year here on the daily, let's do this, that would start to align with, right, this zone below. Boom, previous resistance acted as support. Let's zoom in a little bit further though, and let's take a look. What was the last thing I want? Oh, Fibonacci's on the daily time frame chart. Actively thinking in real time. Here we go. From the top down to the bottom, do we have confluence with anything? The 50% retracement is right at the 510 level. The 38.2 is the 2-day high from the Tuesday, Wednesday session. I think validating some of the levels, the technical levels that we have on the screen thus far. Let's continue along to the hourly time frame chart and see what else we can learn about the NASDAQ side of the market here. Note that the inverted head and shoulders is not as well defined, right? If this is going to be your left, this is going to be your head, and it requires gapping over that shoulder mark at 492.50, holding it for a higher low, and then seeing the rotation to the upside. The risk reward will absolutely be there, but it requires quite a specific, sequence of events if the market's going to make that a reality. Any consolidation that's just down here, I don't know how we could say it's anything other than just highs, lower highs, lower highs, lower highs. You get what I'm getting at, right? Lower highs, lower highs, lower highs. Off of 492.50, bearish consolidation, and ultimately seeking trend continuation underneath 484 for all the downside levels we just referenced on the daily time frame. We'll quickly check in on the intraday anchored view apps. It'll be very similar to our S&P 500, where in this case, we need to gap up and over these two key ones, hold the 492.50 if the counter trend's going to unfold, and then we're looking for shorts here. It goes a little bit further, and then we're looking for shorts back down here. Where do I change my tone? This one's even easier than the S&P 500. Any price acceptance over 510, I'll have to throw in the towel on the bear side, which is fine. Let me be very, very clear about that, right? As soon as the permabull of YouTube starts talking about bearish outcomes, everybody's like, oh, he's just going to remain bearish forever now. No, trust me, just like you, I've got long-term holdings. I don't want the market to be any more bearish than it has to be. I've said that many times over the last couple of episodes, but given the data points that we have in front of us, it does appear as though new money buyers are not stepping into the market. We do have stronger sellers, and there are structural issues that are starting to happen on the higher time frame charts like the weekly, breaking down underneath the double top necklines. Let's get on over to the NQ/NASDAQ side of the market internals. We can see a very similar picture here where, yeah, we did make it near trend higher zone, but only after a dip below the zero mark on the Friday session. So these don't really strike me as new money buyers. Doesn't look like capitulation here yet. If we take a look at the advanced decline line, completely across both sides of the zero line there, not new money buyers in trend higher zone. If we look at the cumulative build out of the tick, it's flat on the session. It did not build positive into the afternoon there. Not thinking that we're ready for a huge, oh my God, back to all-time highs style move. So as mentioned in the introduction, right, we can hold the do or die zone, and we really defined it more so in the S&P 500, but we can hold it. But even if we rally, those threats for lower highs seem real. We are not seeing signs of new money buyers stepping up. I'll be the first one to tell you, when I see new money buyers, when I'm thinking, okay, now is the time to rock and roll, I'll tell you. But for now, we're not seeing that. Let's jump on over to the platform here and let's take a look at our market profile for the NQ side of things. I would reference almost a similar analysis to what we said over in the S&P, where notice that the value area and point of control did move back above the Tuesday and Thursday lows here instead of continuing to accept underneath, indicating a shift in value or slide to the downside. We do still have a poor low. It probably lacks material excess if we were to zoom in. Same thing on the highs here. A value area rotation, or a range rotation, I should say, is maybe along over the high of the Friday session to get to the top of the balance, and then, as we know, reconsidering looking for that lower high opportunity for the next big short. That was the title of the Wednesday update video. And really, the thesis has not changed much. It's just that we've made a lower low instead of breaking through the two equal highs at the top end of the range as of Wednesday's close. So anyhow, That's your NASDAQ. Let's take a look over at the IWM. Small caps are up next. Let's go to a weekly chart here, a little refresh. There we go. Weekly time frame chart absolutely has some issues on the small caps. If we take a look here, let's go to a 5-year chart because we'll want to reference this on the anchored view apps in just a moment. This has been painful for a while, and I don't think anybody should be shocked here. We've been talking about this probably for, more like 4 to 5 weeks. As soon as this became clear that it was unable to rally back up through these highs, it became very clear that, okay, head and shoulders is a possibility, and any weakness out of small caps just sort of diminishes any of the risk on appetite we were seeing over in the S&P 500. Now, we took our time to change tone in the S&P, and we'll fully acknowledge that, but there's no hiding. Look at this chart and you tell me, is it bullish or is it bearish? It definitely looks more bearish than it does bullish after rejecting a new all-time high, coming back down underneath the weekly breakout level, breaking the neckline of the weekly head and shoulders, underneath the weekly 50 SMA, testing the weekly 200 SMA. As we know, if we do something that looks like this is do or die. It's either small caps will hold right here, right now, and will not look any further underneath 200, or goodbye. More pain for the broad market as a whole, probably seeking over time the bottom end of the balance range here. That would be a nasty, nasty move for really U.S. equities as a whole, not just the S&P 500, but U.S. equities as a basket, right? So this is an idea. You need to hold here on the weekly time frame chart. It needs to hold. This would really start to suggest a monthly, maybe equal low at this point. Remember, we had been very, very wary about the monthly close just in last week's episode of the weekend edition. The fact that this is holding here, it's like equal low is stretching it at this point. Ideally, it would have been a higher low. So that's all the considerations of the structure and trend of the higher time frame scope, if you will. Solid red-bodied bar, lower wick, similar rinse and repeat to the S&P and the NASDAQ. Let's come in here with our anchored view apps because this one is interesting to me, that we've closed right on the lowest low of this major, I would just call this a bear market in small caps, right? We've closed right at the low anchored view app here, which is above the top end of the balance. So as said, it's do or die. It's either now or never out of small caps. They will either rebound and we will be, okay, maybe we're doing all right and the pain will stop. It'll stop being as aggressive. Or, right, we get a lower high, a reattempt. I would then start thinking about what? A breakdown. Any lower high and then a reattempt to an equal low dramatically increases the odds that you go through that level. At that point, let's say it takes a number of weeks to play out, perhaps it's reasonable that these anchored view apps will meet us there for potential confluence. It's an idea, and it will require some time. We're not jumping the gun on this thesis, but it's just something to think about. The major thing is 200. IWM 200 is your absolute key. Let's come in here with a Fibonacci from the bottom end to the top end of this move, underneath the 38.2, which was holding as of last week. That is no good. That is a bearish development, of course. This would reinforce your do or die at the 61.8. Of course, coming in from this low to the high, no surprise that the 61.8 has given way, and we would be expecting typically a 100% retracement. Notice in this case, we would be underneath the 200 level, as well as interfacing with the anchored view apps from the all-time high, as well as this low after the balance really started to emerge. That's 196.56, give or take, so about 4 points underneath that 200 round figure. The threats are there on the small cap side of the market. I think it's very clear. It's very obvious. It does not take, a huge detailed look into all of this. Another thing to point out is that we're moving away from the high volume node, obviously the point of control in yellow there, and we are moving into the next potential target at 200. This is a high volume node from this perspective. Is it reasonable we might find buyers here? As said, it's do or die. We have the do or die zone in the S&P. In the IWM small caps, it's very clear that 200 is the do or die zone for any further pain. Not that we already haven't seen quite a bit of aggressive breakdown out of smalls in the first place. Let's move it on down to the daily time frame chart. We all know that the conversation here really revolves around 2 points. It's tying in the technicals with the fundamentals. As soon as this balance range broke down with the premise that the Fed is now going to cut rates 3 times in 2025, we've been talking about the R word, the recession word, and the growth scare. This, of course, continues to be top of mind as long as IWM is sitting on the lows. We had much more of a balanced week after the Monday breakdown, but much more of a balanced week relative to some of the slight continuation we saw out of the S&P and the NASDAQ there. So that is worth noting, where if we do get over, I would say this 209.25, the counter trend is likely available in the IWM as well, in which case we are looking for lower highs up against 214, then rejecting back to the downside here and here. Anything underneath 204 opens the door to 200, the magic do or die zone we were just referring to in quite a bit of detail. If we go through 214, not the end of the world either. We can certainly see something that looks like this. Consolidation pokes through. I would still be very open-minded to a big-time lower high being set underneath 218 unless things change from the recession narrative perspective, from the fundamental perspective. As of right now, given some of the additional charts we'll cover today, I don't necessarily think that that's the case. Notice also your daily 50 SMA as well as 200 SMA may, we don't know for sure, but may act as confluence supporting that 218 could be a serious lower high contender. If we are going to see straight downside, we talked about the 200 level. It's technically 198 if you want to be precise there. Then below that, we have 190, 175 to give you a level. Just like the S&P 500, this is more similar in the sense that you have a balance range. Look below and fail on Friday. Any higher lows over 204, rotate to the top end of the range. Any straight up breakouts can also see that counter trend unfold into 214. Be mindful of this smaller level in here, which is at 211.65. That is something to keep in mind, but I'm not betting the farm on that particular level there. The 214 strikes me as being far more important. I know we didn't cover the upper and lower bound of the weekly expected move, but you can kind of see it here. This 214 is confluence for that lower high. It's 212.99. Let's just call it 213. Then the lower bound is at 198.87. If we throw on the intraday anchored VWAPs, do we learn anything new about small caps here? Not really. I would suggest that just the hold of 204 might keep the look below and fail in play. The anchored VWAP is already starting to suggest that it's over 204, so you're not getting confluence on that support. It sort of strikes me as more so this could easily neutralize and be a very choppy trade to try to take. And let's not forget, first things first, this is just a bear flag until proven otherwise. You could try this counter trend if you'd like. You could make that attempt, but the reality is it's a bear flag until proven otherwise. And in theory, given the trend and the headwinds that the markets face, I would think that this may even just be the higher probability outcome underneath 204. So that's what we're seeing there. I know we didn't look at the not the VWAPs, but rather the Fibonacci's from the start of the major breakdown to the low. 61.8 confluence with that 218 reinforcing the level there, and the 38.2 is actually pretty nice at the 211.65 mark that we were just referencing as a backup level, so you could carry that forward. Let's check in on our Russell market internals. Any big change at the exchange/index really level here? No, you're not seeing any substantial volume inflows on the Friday session as we get the counter trend here. The advanced decline line is all over the zero mark, and you can see that the cumulative build closes out flat after a bearish morning. It was unable to really recover and make a bullish impression there. Once again, new money buyers just not getting active across the three indices that we really focus on the most here. Let's finish up the Russell with a look at the market profile. What can we see over here? Anything different than the others? Not really. You're seeing an extension through the lower edge of the balance range. Value is higher and the point of control is higher. When I say higher, I just mean back inside of the major white box. It did not develop in the downward direction. So what does that mean? It's possible that the counter trend is more likely now instead of just straight up continuation. So we'll watch out for that. Of course, if we were to see a move underneath the bottom end of the range, which is in alignment with the bear flag breakdown conversation we just had, it would mean that anybody who did try to buy this, anybody who's bottom fishing here in the small caps, immediately off sides, right? It's not like the value and the point of control is down here. Okay, that position is being held from the lowest low of the Friday session. It appears as though anybody who was transacting in smalls, the net position, the net transaction level is much, much higher. So any breakdown underneath the bear flag lows, it should open the door for further downside. Let's take a look through the S&P sectors. This is where we can pick up with the capitulation conversation. Let's take a look here. This is not filtered by the correct thing. There we go. Let's do it this way. There we go. So weekly performance, who was leading, who was losing, and where was the weight? Consumer staples lead the pack here, only up 22 basis points, but they were green. The healthcare sector up 17 basis points, small, but again, green. What is interesting about this? Well, we know both of those sectors are technically D for defensive. So is this a risk on market? The answer is no. Is it a capitulating market? The answer is also no. When there's nowhere to hide, when the market is totally selling off, there's, oh my God, the headlines have never been worse. The market's crashing and going to zero. Buckle up, duck and cover under your desk, call your mother and say, hey, it was nice knowing you. When that happens, everything's going to be down 6%, 5%, 4%, 7%, 10%. We've seen the SMH in some of its wild swings be down over 10%. when and if the market capitulates. Notice the if statement there. We're not saying it has to, but when and if it capitulates, you will see a nasty, unbearable move in the S&P where there is nowhere to hide in the sectors. There will not be a speck of green out there. And we have not seen that yet. We've seen two-sided trade. We've seen rotation. So that could go both ways. And, the conversation is nuanced. Everybody always wants a black and white answer. Is it bullish? Is it bearish? You could interpret it both ways. You could say, we haven't seen capitulation yet, so therefore I'm expecting further downside in the market. We know that things are starting to get intense. We're waiting for that capitulation moment. Things are going to get worse. The other thing to say is, no, this has been a mild pullback. In the grand scheme of things, it has been, right? It's a 7% pullback from the highs with a rotational sector list where it's not outright Armageddon. People are rotating into defensive things. Yeah, we might go through a little bit of a rough patch here, but it's not that bad. The market may find its footing and we may continue in the upward direction. I think that's a little bit too optimistic given some of the structural breakdowns on the weekly. I'd be a little bit more of a proponent for the let's look for the big capitulation moment before we start talking about a bottom. That's my personal interpretation, but I could see both sides of the same coin. Let's take a look through the sectors now. What do we see out of the XLP? Is a bear market going to look like this? No, there's no hide. Look at how far we are from the all-time high. We're right there. We're within spitting distance from the all-time high in consumer staples. A bear market would have been this set a lower high and capitulated underneath the lows with the technology sector breaking down as well. We didn't get that. Let's take a look at the healthcare sector. It's not near the all-time highs, but it's certainly putting in an impressive recovery effort. We've been talking about this, inverted head and shoulders. We're sitting near the pivot highs, the local highs of this overall move. A market that capitulates and is like, oh my God, and that's, because that's really what you need for a bottom to form, right? Healthcare would be breaking down from this as a double top, as a distribution under the neckline. We didn't see that until last week. Let's take a look at financials. Yes, they're down the most. They're down 6% on the week plus. But want to know what's crazy about financials? What happened on Monday? We made a brand new all-time high out of the XLF. Brand new all-time high. Is that characteristic of a bear market that's capitulated and is going to zero? Not yet. Now, I would say that this is now acting as overhead supply. There was a very aggressive breakdown from that. We do have a hammer candle on Friday where we went for a gap close. This is back down to a majority of the bank earnings. This, of course, is the election gap up. This is bank earnings. We've closed that gap, so gap fill reversal is absolutely a possibility. You could see this counter trend unfold in the S&P 500 based on the XLF going for a reprieve bounce, but what does the next step become? Yeah, we get a counter trend this week. Any lower high, though, underneath 5070, now we're starting to talk a little bit more about that capitulation. Okay, the major trends are shifting to down potentially, right? That's that. Discretionary. This is the pain, right? This is the pain that the market's been feeling. And we know this is primarily Tesla and Amazon here. So this retest of this flat top breakout, which led to a nearly vertical move, daily 200 SMA, hammer candle, look below and fail, closing back inside the previous day's ranges. Not unreasonable for a counter trend move, but the conversation continues where we're thinking about lower highs. This does not look like a big bottom formation yet on the XLY discretionary. As we look at the semiconductors, we've been talking about this. Sure, we've seen a move lower. Does not look like a capitulation. This is capitulation. This gap down over here, these gap down. So let me zoom in on this. And this is the yen carry trade explosion, right? This gap down paired with the following day, another gap down. That's what capitulation feels like. That's where it's, oh my God, I thought this couldn't get worse. Yesterday we gapped down. Okay, we started to hold a little bit towards the lows. The next morning gap down again. After this breakdown already, this is what capitulation feels like, right? This is what if you're a proponent for finding a capitulation style bottom, that's what the market needs to experience. And through the arguments we've put forth in today's episode, the S&P, the NASDAQ, and even small caps have not felt that yet. So is there further downside potential? Yeah, I would say yes. And the key word there being potential, right? If the market rallies here out of semiconductors, and note the look below and fail, and this is a really ugly range, but look below and fail on the Friday session, closing in the midpoint. If we continue the rally, what's the threat, right? Lower high here, 237 has been carried forward as a very monumental level over the past couple of, I was going to say weeks, but months, almost years at this point. Let's move along to the energy sector. It's not doing much. It's inside of its range. The sine wave here continues. So any mathematicians can plot that on their TI-84 and we'll be good to go. Let's move along to the technology sector. What do we have over here? Not a shock, right? This breakdown underneath the daily 200 SMA now gives the opportunity for a lower high to persist underneath that level. And I think that all of these things in combination still support more of the bear thesis, perhaps a more protracted, let's not jump the gun, but let's zoom out a little bit. Let's go out to 2022 because this is a conversation that needs to be had. The market, for the most part, is still in an uptrend on the higher time frames, right? I'm talking about monthly, really, when I say that. When these lower highs are set, not every single bottom along the way of a more meaningful downtrend is going to be a capitulation style bottom. This certainly was it. This is that gap down notion, right? Oh my God, we're crashing from the lows. Here's the gap down again. But then we get a little bit of a counter trend and it gets worse, right? And then once the weekly trend flips, and the weekly trend would flip when? Well, this starts to be it on the daily time frame chart. I would argue this is your weekly high or low. This is then your weekly high or high. Once that starts to take place, maybe you're out of the woods. And I would say that for the most part, if you're trying to track and follow along, lows, lower lows, highs, weekly higher high, yes, but where's the higher low? You only have one component of a trend change, whereas here you have two. Higher low, as well as you could say this is a higher high or this is a higher high, right? And again, don't feel bad about missing the exact low of the market. Remember that there was an aggressive breakout here. This was like setup, long setup trading 101. Inverted head and shoulders, boom, there you go. So it's not like you have to buy this exact low. Of course, if you're able to grab it, by all means. But there's really that extra layer of confirmation I think is very valuable. I know it's not necessarily pertinent to this upcoming week's worth of trade, but my point being is if the market is going to flip into a more protracted downtrend for a longer period of time, this lower high that then comes down could easily continue. It doesn't have to be this big bad bang where everybody's expecting the market needs to capitulate, needs to get this big emotional bottom basically, and then immediately snap back into an uptrend. I mean, yes, the higher time frames still look generally good. When I say higher time frame in this context, I'm talking about the monthly, as just said. But this is a conversation that I think needs to have some nuance there, right? Let's move along to utilities. What's happening over here? We can reduce this so we're not loading so much data onto the screen. Let's try that again. Utilities breaking down, the most bond-like sector, even struggling with some pain here as well. A lower high underneath 77.50 is just bearish pressure for the market. Anything that's in here I would consider neutral. If it's going to be a tailwind for the market, it would have to break out over the pivot highs, 80.25. Let's speed it up here. Industrials, they look weak. We know that we have this big weekly lower high. We know that we have these equal lows. Yeah, there's a little counter trend move unfolding from here, but any equal low breakdowns open the door through the thin structure breakdown, and that, of course, is painful for our market. This is an example of the potential, not that it's sitting low on the lowest lows yet of the overall structure. That would really have to be underneath here. But when I say markets crash from the lows, this is not a market crash. A market crash is when this happens, but from here. And now all of a sudden we're like this, right? That is much more painful. So just an example, let's move along to communications. Anything bearish about this chart? Yes, we've pulled back from the all-time high, but this general structure does not strike me as being nearly as bearish as some of the other things we've seen. So when I talk about rotation, this is still in the rotation aspect. We've seen a lot of two-sided trade through here. It's very possible that we hold this set of low, previous resistance, but for higher lows now at 99.15. If this persists, this is very difficult to say that the XLC is a bearish looking chart. And of course, the most helpful component here being metaverse. Let's take a look at materials. Looks pretty weak, and we can combine this with the XHB for home builders. Looks pretty weak as well for an opportunity for the lower high to continue to put pressure on the broad market. So this adds into that recession narrative, or just generally more bearish outcomes for the market. Let's move along to real estate. As rates have really come off, real estate picked up. Now that rates have rallied a little bit, you're seeing that sensitivity. I would watch at this level quite closely. Generally, the chart doesn't strike me as an end-all be-all for the market here, real estate as a sector component. It's also such a lightweight component that it's not going to move the needle. I would just want to see whether or not do we accept up here or do we accept down here using that 4270 as a delimiter. Let's take a look at the TLT bond, the long bond here. What do we see? Possibility for a higher low, hooking prices back to 93. I think we've seen a lot of flight to safety trade unfolding, and it seems as though this is a reasonable place for that trade to continue. We have previous support acted as resistance, perhaps can act as support again at 89.75. Any consolidation here off of these lows in general, builds out the next base perhaps after a trendline break to establish a weekly set of higher lows, weekly consolidation, weekly price acceptance higher, then looking for that follow through over 93, which continues to act as a risk off gauge. Let's take a look through some of our sector ratios. Here we go. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. This is still an X. This is an X over here. This is now an X. Reason being is that we know, as of at least last week's check-in, we were talking about previous resistance possibly acting as support coming from the highest high. Well, we broke down underneath the retest level. We're still over the daily 50 SMA, the gold moving average on all of these charts, but it would have been much more beneficial to hold up over the breakout level. It simply did not take place. This is technically D for defensive, so it's pointing in the upward direction. It's a heavier weight sector. It's the fourth heaviest weight sector. We'll go neutral on that, but it is defensive. This, of course, gives an X. This is risk off. This is risk off as well. As we look at some of the specialized ratios, surprise, surprise, it's the same thing. Risk off, risk off, risk off, risk off, and risk off over here. Perhaps one of the biggest fake outs in recent history out of the ARK Innovation Fund here, Cathie Woods. It was looking good for about a week and then quickly flushed right down the drain. And it's not just the relative chart. You can take a look at the ARK Fund, ARKK, breaking out, hammer on the retest, first attempt at 63, no dice. Straight through these lows at 60, straight through these lows at 56. Sayonara, lots of overhead supply, plenty of risk for a lower high to keep the market in what? Well, I would say risk-off mentality. Let's jump on into some of these currencies that we were talking about in the introduction. The dollar has been getting absolutely demolished. Now, why might this be? We can have a little bit more of a nuanced conversation this week about this. Well, I think you're seeing foreign currency go home, basically, right? You're seeing money rotating out of the dollar into things like the euro. You're seeing the yen strengthen a little bit more materially to the dollar. And those two are a big topic of conversation. The yen carry trade, as well as currency going back to the EU, with not only the tariffs, but just the tensions geopolitically across the world. So as the dollar breaks down aggressively here, in theory, it's sucking money out of equities. Now, it's a double-edged sword because a lower dollar could also help companies in the S&P with earnings that have international exposure. But it's at this rate, I think the correlation is quite clear that it's money flowing out of U.S. equities to go back home to their own European primarily and Japanese economies. And with that, we can move along and pop in up here. Let's go to the 6J for the yen. The yen is strengthening in here. You can see it moving in the upward direction. This is a weekly time frame chart, of course. This is the yen carry trade where everything sort of blew up on the first initial, like, whoa, the Bank of Japan is going to need to make a move that's far exceeds what they had thought. And that's continuing to be the case, actually. They're moving rates more aggressively than perhaps previously anticipated. So that's the yen. And if you would prefer, you could look at the USD/JPY. Similar chart, but inverted, right? You would be looking for a breakdown here. This is the yen carry trade blowing up. We've broken down through what I would consider a very key level at 149.25. That's the yen. And then we could look at something like the 6E, which of course is the euro. This is the futures. I use the futures more so than the spot. Anyhow, this breaking to the upside is a pure example of the tension between US and the Eurozone, really, and the perhaps need, given some of the headlines that have come out, for Europe to step up and maybe use some of their own dollars to support any other foreign countries with aid that they deem fit. So money coming out of U.S. equities to support those ideas, right? And you could also think of it from an investment perspective, right? Interest rates, you could use this almost as a proxy, right? Whether or not U.S. rates move lower or foreign rates move higher, it spells the same outcome. This becomes less attractive to park your cash. You would just go home. Right? So foreign investors pulling out, going into the euro, going into the yen. I think the most egregious move, of course, is the euro. We could see this. Just look at the bar from last week, and that's a conversation that we're going to continue to have. Let's take a look at gold as a proxy for currency as well. This continues to signal risk off. We know that this breakout through these equal highs in the past has signaled like, hey, looks as though people are taking it easy, flight to safety, and that continues to align with more of the bearish thesis that we've put forth for the S&P 500. So it's not just a technical weekly breakdown of the neckline. It's like all of these supporting evidence pieces. And the market's so fascinating to me. And this is one of the reasons why I love it so much. And maybe you can resonate with this as well. But this is reflected in the S&P 500. The euro is reflected in the S&P 500. All topics, and this is a great quote from Chris Shivako, and always give credit where credit is due. I don't know if he came up with the saying, but it just is, it rolls off the tongue so smoothly. Price charts reflect all opinions of all market participants on all time frames of all known things. So the S&P 500 breaking its weekly trend aligns with a flight to safety happening here in gold. It aligns with the euro breaking out and money coming out of US equities into those other domestic, European markets. Interest rates, if we just take a look, let's move over to interest rates now that we've covered gold. Interest rates falling off of a cliff here mean that the yield is no longer as attractive to perhaps something like the European rates or the strengthening of the European currency, really, or the yen, Japanese currency, starting to get some strength based on the rates moving higher over there. So it all adds up, and the fascinating interplay between these things, you could say, is all just reflected in the S&P 500 with some of the weaknesses that we're seeing. Now, these are just subcomponents of the S&P. There's still some things to be optimistic about. You still have things like, wow, the promise of AI into the future, the promise of what that's going to do for healthcare. And when I say healthcare, not determining whether or not someone gets their insurance claim approved. I'm talking about drug discovery. I'm talking about protein sequencing. I'm talking about all of these things that AI might deliver. You talk about Neuralink. You talk about electric vehicles. Quantum is a big one in the headlines. There's things to be optimistic about, which is why, this is not enough to cause the S&P to go to zero. We're getting way off the rails about this conversation, but it strikes me, especially in these moments where all of the interplay is so well on display. It's all right in front of us. It's fascinating stuff, right? And that's, in my view, what makes the market so fun. All right, let's get back to business. Inverted ZT continues to suggest that we're getting those 3 rate cuts. I don't think we should delay any further. Let's just take a look at the Fed tracker tool over here, and you can see that the market's like, give it to us now. 88% odds now of a continued pause in the March timeframe. It's not this upcoming Wednesday, but the Wednesday after that. We will stream it live when appropriate there. The current rates have been being pulled, or the forecast has been being pulled in the downward direction. It's like, give us the rate sooner rather than later. Give us the cut sooner rather than later. If you take a look and delineate where 2025 is, this has continued to just move in the upward direction. At first, it was like, okay, maybe you get 1 rate cut in December. Then maybe you get 2 rate cuts, and they bumped the second one to December. The first one was a little bit higher up. We were bouncing between the June and July timeframes. Now we can clearly see 1, 2, 3 rate cuts through 2025, and this is why that recession narrative comes into play over on the small caps. They should be performing. As the market is forecasting these 3 cuts, it's basically telling us things don't look good on the growth front, and perhaps Jerome Powell is going to have to take some action there. As we move along to some of the fundamental data that came out this previous week, we got manufacturing PMIs coming in over the 50 mark, which is fine, but most importantly, the services PMI came in over the 50 mark after a previous coming in underneath. The ISM services also came in just fine, still indicating decent growth on that front, which is important because that's where the growth scare really came in from in the first go around. We also know that net exports has been a big contributor to GDP coming down. The non-farm payroll ADP version gave us a little bit of a scare, but if we look at the Friday session, the true non-farm payroll really did not miss by a huge magnitude. I mean, we had 151 versus 159,000 expected. It's really not a contraction, even though we've been seeing some of these anecdotal headlines about, some layoffs here, some layoffs there. The unemployment rate did see a small uptick, but this is well within the range of what we were expecting based on anyone who's been watching this, and we check in on it every Thursday, literally in the pre-market prep. We knew that this spike here, we knew that some of the uptick there was going to be a cause for concern, and it was very likely that this was not going to remain unchanged at the 4% mark. No surprises there. I think that the data that came out was completely fine. As we look forward to the upcoming week, and then we'll recap with a little bit more detail some of the other things that were released, it's the JOLTS numbers, but this is a really old read. I don't know why they're releasing it here. It doesn't tell us in this particular view. This is not even, I don't even think it's the February number. I think that this is the January number, which is crazy because they did not release this with the last week's labor data, right? Which is just kind of wild. Maybe I'm confusing that, but it's just really odd with the jolts. Anyways, we'll watch it. I think that this is less important. Of course, the big deal is Wednesday. This is the full Monty. It's the CPI print. It's the next inflation read. We, of course, are going to be watching that very closely. We will have coffee and donuts up in the penthouse for the pre-market prep, so come out to the show and join us every morning at 8 o'clock Eastern time. We kick that off. We'll see how inflation comes in. The 10-year bond kicks off at the 1 o'clock time frame on that Wednesday session, as well as the 30-year bond and PPI on the Thursday session, March 14th. Consumer sentiment has been a big driver of the market recently as well, and it's always the preliminary reads from the University of Michigan. That is Friday, March 14th, which is Pi Day. For anybody who celebrates, have a slice on me. Let's move along to a couple of these deep dives on the data that came out last week. This is the non-farm payroll month-over-month change. And what I want to point out is the government contraction, of course, and this is just a topic that needs to be discussed as it's literally impacting the economy. Look at the standard hiring that's been happening here. So a little bit of a hiring freeze in the government that you can see literally show up in the data. In terms of contraction in other sectors, leisure and hospitality down a little bit. I would think with the seasonality coming into the spring and perhaps summer, that would pick back up. Not a huge issue there. The other one that was down was professional and business services. There's usually some higher end earners there, so watching out for that, but it's just a contraction in the growth of jobs. It does not necessarily mean huge layoffs necessarily happening across that. It was flat, basically month over month. In terms of the cyclical side of the economy, the construction side definitely important here, seeing a pretty decent uptick on par with some of the normal months where it expands, but definitely an uptick from the previous month, which I think is important when we're considering that XHB chart that we've been going over the last little bit. Moving along to this here, this is the breakdown of the month-over-month net change for the government only. And the conversation to have here is, as maybe Doge is talking about, really putting the pressure on federal employees. You are seeing the federal number drop by about 10. Obviously, what is this in terms of thousands? So you got a 10,000 employee offset on the federal level, but the local level added 20. The state level added 1. And the reason this conversation is important is because if you look at how this is actually unfolded, in terms of federal government employees, they're not the issue in terms of government bloat or, as it's called, and all sorts of opinions upon this, but let's just consider the chart in front of us for a second. Federal employees are not the issue. They've remained stable, steady, no increase in federal workers for decades at this point. As we look at state government, yeah, it's grown a little bit, but that's pretty stable as well. Where the huge bloat is about, this person's an admin and this person does that, and like all these maybe things that are referenced as inefficient, that's this. That is the local government, right? And you can see, look at how it started here versus where it wound up, right? So when we hear about these layoffs maybe happening at the federal level, it doesn't even seem appropriate that that's where, to use really rough terms here. And this is not to say that one thing is good or bad. This is just the nature of what's in front of us in the data. To trim the federal employee number by that much is not accomplishing, so to speak, the air quotes issue of where there is maybe too much admin. So that showing up in the employment data does not strike me as being, these federal layoffs are going to crash the economy and cause an unemployment recession. You would need to see the government at the local scale dramatically be reduced, which just is not the case given what we just saw through the data. All right, so that's that conversation. Let's move along to the GDP prints. You can clearly see a big move to the downside here. We've been tracking this over the past couple of sessions. The next update is on Monday, March 17th, so we'll keep tabs on that. That's, of course, 2 days prior to the Fed announcement. But this growth scare is apparently real. It's continuing to persist in the Atlanta Fed forecast here. And as we look at the subcomponents, we know that this back over here, the biggest one was net exports dropping by about 3.29%, and then followed by the PCE, consumer spending, dropping by 0.66%. That is a big deal. As we continue to look at these forecasts on the subcomponent breakdowns, not the change in subcomponent, we're still looking at fairly aggressive, revised down net exports, and consumer spending is down also. Let's take a look at the earnings insights for the next couple of, I would say, the previous quarter is basically wrapping up here. There's some big names we'll talk about in a moment, but the big deal is this, and we mentioned this in last weekend's update as well. Kudos to anybody who's made it to this point in the show. Anyhow, But the revision to the downside out of Q1 2025 earnings aligns with what we saw into the end of 2023, where the market made a weekly pullback. So as I was saying, it's so fascinating on the when we were looking at rates and currencies, right? This as well is being reflected in the current outlook of the S&P 500. And if we just compare what similar outlooks may have done to the market in the past, we know that there was a weekly downtrend there. Well, we just broke a weekly double top neckline. Is it possible that the technicals aligning with the fundamentals here give us the green light to say, okay, let's be a little bit more cautious and look for further downside in the S&P? To me, the answer is absolutely. Moving along to the earnings calendar for the upcoming week, the big heavy hitters are simply going to be Oracle, are going to be Adobe from an AI perspective, and then just because it's a decently priced stock, Ulta Beauty can tell us something perhaps about the state of the consumer as well. If you wanted to use some alternatives there, you might say something like Dick's Sporting Goods could fall into that category, Dollar General could fall into that category. Anything else here that's capturing my attention? Not really. Maybe Sentinel can fall into the category of being interesting, give us some perspective about some of the peripherals of tech, if you will. That's it, I would say, on the earnings calendar. And with that, let's jump back into the technicals. Let's see if we can get the job done here and finish up today's episode of the weekly watch list. Here's the TLT ratio to the S&P continuing to signal risk off, not a shock. Let's take a look at bonds relative to themselves. The longer end of the curve has been doing a majority of the work, getting larger, causing these things to move in the downward direction. We know that Jerome Powell intervention has not taken place yet, but it is being priced in aggressively. This is more about the market trying to do Jerome Powell's job, more so than inflation, in my opinion. As we move along to the credit spreads, they are starting to move in the upward direction, notably on the HYG junk bond side of things, the lower pane of the top charts there. We've been waiting for this, and it is starting to confirm a little bit more so that volatility creeping into the market, the uncertainty, which of course causes more pressure in equities down below. This is adding up. If this had remained flat as this breakdown was taking place, maybe I would be more optimistic about a bottom being found, but we are just not there yet. Let's move along to, after credit spreads, is the HYG in isolation. It's still somewhat divergent from the S&P equities, but as we fall into a regime where the recession narrative, the bonds are starting to outperform a little bit more so, you can go back, you can fire up the ratio for things like the dot-com bubble bursting, although this ETF was not all the way in play for that, so your data might be a little skewed, but definitely through the great financial crisis, junk bonds actually outperform slightly the S&P, and that's enough, in my opinion, to say, okay, this divergence, it's technically there, but it's not going to help us find a bottom in the S&P. Typically, when the market's fine and dandy, and then these things disjoint, that's where you make more note of those divergences. Let's move along to Bitcoin. Continues to look weak here, rejecting the overhead supply on the reattempt move back to the upside. So, as noted on X last week when the tweet came out about, hey, the reserve is being built, I don't buy it. I don't buy it with this overhead supply. It continues to reject. It looks weak. This still looks like a risk-off indication in my view. Let's move along to breadth, which also looks risk-off. We can see the rotation to the downside out of the 200 and 50 SMA lines, respectively. New highs versus lows saw an uptick here, however, still underneath the zero line. So relative to last week, sure, a little bit of an improvement, but are we positive? No, not by any stretch of the imagination there. As we look at the RSP, we know that it did not hold the bottom end of its overhead balance here. If there was going to be a higher low, then great. That would have kept us more so on the bull side, optimistic side of the market. Not the case. Equal lows on the table. I would think that a lower high is the nail in the coffin, and then we're really looking for 168.25. Let's take a look at QQQE. Equal weight NASDAQ to the equal low. Whereas we're through it over here, the call out would just be that it did not hold the higher low as of the end of last week. It's sort of right at the level. No dice, equal low. It's confirming the downside in my opinion here. The Dow Jones Industrials versus the transports has been divergent for eons at this point, but noting that we did make a new pivot low in the transports, that is continuing with the bearish thesis here. Let's look at the volatility. The VIX is the first metric, and VIX here has... When I say there's been no capitulation, yeah, we could talk about the VIX getting up and over 2050, but look at these spikes. I mean, we're not even close. We're not there. When it comes to volatility, getting out of control, a gut-wrenching gap down, oh my goodness, this marks the bottom, X marks the spot, we're not there. This is a very orderly move in the upward direction over 2050, sure, but not to a degree where I would say, wow, I can't believe the market just made that move. Everybody must have been scared out of their brains, and this is going to be it, right? We've seen markets before stay over 2050. All of 2022 was basically that, especially on the heels of the sickness. So this orderly move above the level, not really seeing a vol spike, does not indicate to me that a bottom is here yet. And we could see the same thing out of the VVIX, where it's just hardly broken over the 120. It's come back down underneath. You got to get a spike. We're just not seeing it. It's not in the cards. Not in the cards as of right now. Let's take a look at volatility futures. This just continues to get deeper into a backwardation. So the environment is right for a nasty gap down, a big capitulation style move. The environment is absolutely correct. It's there, but we just haven't seen that capitulation yet. And we saw that with the two-sided trade earlier in the conversation with the S&P 500. Even the one-day VIX has seen an orderly grind in the upward direction. It has not seen like this big breakout. It's been higher lows, higher highs, higher lows, just meandering its way in the upward direction. So that volatility spike, and FYI for folks who still have not seen this study, you don't need it. You can just take a look at the VIX tab over here, the trade tab, type in the VX futures, close this up, and scroll on down to product depth, go to futures, and here is your volatility curve. So present day volatility is higher than what the market is pricing in for May, is higher than what the market's pricing in for June, and only then does the curve start to normalize. So this is called backwardation when the curve looks like this, and this is called contango. We are in backwardation, which once again means that the environment is correct for a capitulation style gap down, but we just haven't seen it yet. Let's go back on over to the charts. Let's get into our core list of companies. Let's finish up today's episode of the weekly watch list. Fun conversation today. Hopefully you guys have enjoyed it. Thanks for the feedback so much in last weekend's episode where I had requested some feedback. It appears as though the conversation is helpful. The colored commentary is helpful. So we'll keep it up. 129, big time over and under. Very hard to say anything bullish about NVIDIA on the daily time scale. You've got yourself another Wyckoff distribution up here. Taking a look, zooming in, you've got the look below and fail, but as we've made note in a number of other charts so far today, counter trend move. Sure, show me the retracement, show me a lower high. Anything that remains under 129, underneath your daily 50, underneath your daily 200, hard pressed to have more of a bullish stance here, especially with the SMH underneath its 237 mark. So that's that. No need to overcomplicate it. We can look at the hourly real quick. I would think, and this was really an idea for the Thursday and Friday session. If we had opened here on Thursday, yeah, this was the idea. The fact that we opened underneath and rejected, beautiful, right? So it becomes difficult to even want to play into a break of the Friday high to get this move to here in the first place. I would want to see this. Okay, maybe we're starting to deal with the double bottom. Over the neckline gives you that possible counter trend here over 119, 125.25, 129 on the upswing. Any consolidation that remains below 115.50, call it for what it is. It's bearish consolidation on the lows, looking for follow through to the downside on the daily chart. That would start bringing us into the 104.75. And then there's the danger level, right? Because this is where you have, this, I was thinking more so along the lines of the S&P. I guess we're not quite there yet. I was going to say thin structure retracement. That was already here. That was already here at the 115.50, right? Where I was saying that we had that thin structure before the next balance to the downside. We've done it. It's all set in NVIDIA. Let's move along to Microsoft and see what's happening from this perspective. A lot of overhead supply continues to keep me bearish on Microsoft overall. As long as lower highs persist underneath 403.25, I don't think there's a reason to jump the gun on the long side. If there's going to be a big reversal, show me the inverted head and shoulders. Show me the confirmation. Show me the higher low over 403.25. I'll change my tone. There's plenty of range to trade for in the upward direction, back up towards the top end of the balance. We're just not there yet. The only interesting thing happening here is the fact that we do have a daily higher low starting to creep in around 388. So is it possible that this is like a nuanced hourly inverted head and shoulders? Let's take a look. It's possible that this is starting to emerge here, left, head, right. How do we trade it? Leaves a bit to be desired. This is like a choppy zone that I would not want to second mortgage the house on. I would tend to think that this idea to get to the neckline is probably the most lucrative if we're going to do anything out of Microsoft on the long side. If we just get consolidation here, I would just be open to where's the breakdown? Where does the continuation of the downside happen because of the amount of overhead supply sitting on this chart here? Microsoft has disappointed people for how long now? How many years has it been? At least 2, right? 2020, all of 2024, let's say that. So maybe not all of 2, but a year and a half of disappointment, not getting any appreciation out of the stock price. kind of rough as we start breaking down through the weekly bottom end of the range. Let's move along to Apple. Let's drop this thing back down to a daily yearly chart. There we go. Apple's an interesting one because there's some semblance of relative strength here where the market, it's not been straight down out of Apple. You could also make the argument for this sort of as a trend line creeping in here. We're staying over the weekly key level, which as we zoom out is just coming from this, of course. Very hard to trade it intraday though. If you look at the actual activity, I mean, brutal lower wick in here, brutal sell to then recover, two-sided chop, rejected the level, could not really hold, and then get hooked back into the equal high, all over the place. Maybe, if anything, Friday was the best opportunity on the higher low hold over 237.25. That continues to be the idea walking forward. If it can hold here, maybe risk reward in the upward direction, 243, relative strength, but where's the opportunity? Really lacking here out of Apple. So it is the name that's had the best relative strength and will carry that forward, but it's been tough to pick out that intraday setup, I would say, out of Apple. So we'll take that for what it's worth, I suppose. Amazon, complete rollover. Ugly underneath that 219.25. We've been talking about that as overhead supply. Lower high persisted underneath. Great. Look below and fail on the daily 200, the 2-day lows from the Tuesday and then Thursday session. This prior pivot low in here as well. Started to close a little bit more of the gap and then reversed out of it. So the look here is just that the counter trend might be available for something that maybe looks like this, perhaps. So we take a look at the hourly time frame chart. How might that unfold? You'd probably want to see consolidation here and then maybe a Brigade bolt over this afternoon high from Amazon. If that holds, so 198.25, then a move over $200.25. Maybe you get this as a counter trend, and if it's going to persist, you look for the next one at 205.15. Generally, though, I think the lower high opportunity is far superior at 205.15. If the market's going to rally and reject, and if the broad market remains bearish, what a great spot for risk reward to continue closing the gap to the downside. So I'm interested in that. I'm also interested in a weekly lower high up against 219.25. Now, in this case, there's absolutely more counter trend to be had through here, so let's not overstay our welcome on the short side. If we get this, starts to reject, catches, and then goes for the rip, make sure that if you try to trade this as the lower high, I mean, just because we're in a downtrend and the wind is at our back in this environment doesn't mean that you don't use a stop, right? Let's be logical here. Let's trade this responsibly. So that's Amazon. Let's move along to Google. Similar to Amazon, but I think a better opportunity. I think the counter trend here makes even more sense. Thin structure retracement, a little bit of a base has formed. You've gotten this to this as a set of higher lows over 174.50 over the daily 200 SMA. Nothing but thin structure to retrace back up towards 182.50. Now, when and if we get here, bring it on. Where's the lower high? How can we keep all of these traders as overhead supply? If the market pulls back and then does something like this, okay, maybe we'll change our tone over the neckline of the double bottom. We'll change tone, change trend on the daily, but we're just not there yet. That is Google, and let's call it for what it is. If this is just bear flag consolidation through the lows, start walking down your targets. You can take a screenshot or just, take these levels down on your own. Next up, we have the metaverse. I don't like the fact that Meta looked underneath this area here, previous resistance, in such a strong daily uptrend proceeding. I'm really not fond of the idea that Meta is underneath that level, closed underneath. Yeah, it sort of found a little bit of support down here, but what another name for another opportunity for a lower high. This was one of the ones where I was saying, great, look, awesome relative strength, trying to find a little bit of a footing in here, and it's gone. So the fact that this 635.25 is not holding is fairly concerning to me. If it does just find a lower high, really anything underneath this 682.25 goes. If we look at the hourly time frame chart, you could even just argue that this is an hourly lower high. Highs, lower highs, lower highs. 635.25, which is a daily rejection of that key level. So not too fond of the metaverse in its current configuration. It would have to be. Show me something along these lines. Maybe we'll play in the upward direction. I think the opportunity was on Thursday, and it just simply failed. The setup did not play out, right? The idea was to hold over 648. We talked about this on Wednesday. Pullbacks that hold here. Give me the counter trend back up to 682. Look at where we opened. We opened at the level, could not hold it. Sayonara. Goodbye. So Meta starting to show some signs of struggle also. Tesla. I think we can flip the script a little bit on Tesla. Tesla is trying to find, it seems like it's trying to find a little bit more of a base around this previous breakout level. It's given back 100% of this large break from the previous earnings cycle, and it's trying to find a footing. It's closed the gap. This is the gap, and there's still another one underneath, and we'll talk about that in a moment. But it looked through the full gap close. It printed a hammer if we zoom in on the daily, closed inside of the Thursday range. It's the weekly key zone. I think we want to be open-minded to a Tesla reversal here around this area. It may take some time to play out. Maybe it's something along these lines, like inverted head and shoulders. Maybe it's something like a big-time double bottom and the neckline's way up here. but I think we want to be open-minded to this idea. So 254.50 is kind of a line in the sand. If we could stay, if Friday's low just holds, this is the easiest way to frame it. If Friday's low holds, maybe there's a better bottom that forms in Tesla, and there start to become some better long opportunities on a retracement back to the upside. We're not changing tone completely. Let's not be blinded to the fact that, of course, this is still a daily downtrend with highs, lower highs, so on and so forth, right? Lows, lower lows, lower lows. There's still a strong opportunity for lower highs, and I would primarily want to see this 326.50 act as the next lower high, previous low, then turns to resistance, right? So that would make the most logical sense in here. Even this 310.50 could act as that zone. But the counter trend is absolutely in the cards, given the structure that we're dealing with and the fact that Friday is starting to find a little bit of a basing formation there. It's not like Tesla has completely fallen off of a cliff like it did in this range here. If this continued and we had closed this gap, that would be a different story. But the fact that Tesla is going a little bit more so sideways, trying to find buyers near the lows, it opens my mind to that counter trend possibility. So that's the conversation there. JP Morgan looks pretty rough. Earnings cycle is going to be here sooner rather than later. It's crazy how fast that one flies by. But the idea being, we're already inside of the election gap up range after the earnings breakout here. It did not see a counter trend off the top end of the range at 248, and therefore any lower highs that persist below really puts the pressure on financials as a sector, which had been acting as the backbone of the S&P 500. So 248, big watch. If it is a huge overshoot, high or low back above, I'm still thinking lower high here. 260.60 until that trend clearly suggests otherwise, until we have some sort of maybe higher low and then an equal high breakout. Maybe we change tone back to the all-time high and some, but we're just not there yet. Let's move along to Netflix. Ugly, ugly, ugly. Head and shoulders, right? So this was our primary idea, looking for consolidation to remain in that right shoulder, breaking down through the gap. Who the heck knew it was going to take place over the span of quite literally 2 trading days? So sayonara to the weekly Brigade Bolt from this perspective here. We shouldn't have been participating in that anyhow. There was never a move last week over the 999. But wow, what a gap close promptly. We do get a hammer on the Friday session, so I think counter trend is here, but lower highs anywhere underneath the neckline just obviously open up the door for another short opportunity and a chance to go back to the equal low. 950.25 is that level. No need for the hourly on Netflix. Let's throw it on over to ARM. And let's get into some of these additional trade ideas, and then you'll be on your way. It's a later episode of the weekend edition, enjoying the nice weather this morning. Hopefully you guys are able to do the same recently as we turn into spring. ARM, consolidation on the lows, starting to close over the highs as of Friday. We have 125.25. Let's take a look at the hourly time frame chart. Could it be a double bottom? Brigade Bolt over the neckline, thin structure retracement, 133.50. Possibly a long if the broad market sees the counter trend this week. It's an opportunity to watch out for. At face value, anything that is this, bear flag consolidation down here under 118. Let's go back to the daily. What do we have off to our left? I think it's very, let me frame it this way. It's not a coincidence that this level is right here. So if we don't break the 125.25 and we remain below it, then what persists overhead? Huge overhead supply, bear flag consolidation. We should just look for follow through back into this pivot from back here. 109 would be that next downside target. So honestly, ARM could go either way here. I would be a little bit more partial to whichever direction that the broad market chooses. I would want those tailwinds or headwinds helping me out in that particular trade. Next idea is on GE. GE Aerospace, not Vernova, the energy side. And let's take a look, not GEHC, GE Healthcare. Look below and fail on a balance range. Again, if the broad market is going counter trend, meaning upside, this would be a place to look for some strength. Yeah, you have sort of the head and shoulders formation maybe, but look at the lack of acceleration under the neckline. No closure under the neckline. We had thin structure back here. We had many gaps back here. Daily 50 SMA acting as support. Any sort of hold over 192 and then subsequent Brigade Bolt intraday over 195, if we have broad market tailwinds, probably can seek the top side of the range at 208. So that is GE as an idea on the long side. Next up, let's take a look at SNOW, Snowflake. What do we see here? This one could go either way. I think that the idea primarily would be the short side for me at least. I think that the hammer suggests, like everything else, look below and fail on the Thursday low, especially into this gap. That's quite telling. But if we get a rally that rejects here at 167.75, what a great opportunity for the next lower high in the daily trend count. Keep all of these traders as overhead supply and perhaps reattempt the gap one more time in the downward direction. So Yes, you could trade it both ways. Yes, you could take the counter trend. Who let that slip? 159.34? My goodness, round numbers only, please. If we can get this, awesome. And then the lower high, I think, is the stronger opportunity for risk reward. Back down to the top of the gap, if not ballooning runners through the gap under 153.75 down to 133.75 from the previous earnings cycle back here. That is Snow. Final trade idea is on a fan favorite, PLTR, Palantir. This one is more aligned with ARM, in my opinion. It's more of just a balance range where both outcomes are reasonable. I think that the overall uptrend here is helpful for the bullish case, something along these lines. And that's primarily what I'll be watching for, I think. You can see as we zoom in, very equal lows. So they are mechanical in nature on the lows. I would want to see consolidation in the upper 50%, which is delineated by this 84.75, which is also the previous pivot top from back over here. So consolidation there that then Brigade bolts over 90.75. That to me is a long opportunity for risk reward to retest the earnings gap up low. If we just consolidate out and never get over 90.75, I mean, let's call a spade. It's a bear flag, and ultimately we might go lower into the last pivot low. 73 could be the target on that. And of course, anything beyond that, you'd have to start walking down other pivots. As a day trade, though, as something to look for as an intraday opportunity, we'll be keeping quite a close eye on this balance range here early on in the coming week. That's going to do it for today's episode of the Weekend Update, the weekly watch list, as we call it. If you enjoyed the video or learned anything new, if you continue to enjoy the conversation sidebars that we're having here, let me know in the comments section. It's great reinforcement. It tells me to keep doing what I'm doing. Otherwise, I can just as easily save that internal dialogue for myself, tell you guys the key levels, and move on with my day. Totally up to you. Give me the feedback down below. Hit the thumbs up button, subscribe, all that good stuff. Reminder, we are live every single morning here on the channel at 8 o'clock Eastern time for an episode of the pre-market prep. Every day, coffee and donuts, especially when we have those big major news announcements, labor data, as well as inflation data. We hope to see you here bright and early on the Monday session. With that said, enjoy the rest of your weekend. Have a green trading week, and I will see you in the next one.